Everything you learned about investing is obsolete. The 60-40 portfolio, dead. Buy and hold, dangerous. Diversification through stocks and bonds, that's how you stay poor in the new economy. The rules have changed completely, and most people don't even know it yet. I'm Ray Dalio. I've been studying markets and economic cycles for nearly 5 decades. I've managed money through every kind of crisis you can imagine. And what I'm seeing right now isn't just another market cycle, it's a complete paradigm shift. The fundamental assumptions that guided investing for the past 50 years are breaking down in real time. Let me show you exactly what I mean. In 2022, something happened that wasn't supposed to be possible according to traditional investing wisdom. Stocks and bonds both crashed simultaneously. The S&P 500 fell over 25%. Long-term treasury bonds fell even more. The classic 60-40 portfolio, 60% stocks, 40% bonds, had its worst year in decades. This wasn't supposed to happen. For 40 years, we told investors that when stocks go down, bonds go up. That's the whole theory behind the 60-40 portfolio. Stocks and bonds are negatively correlated. They balance each other out. One zigs when the other zags. But 2022 proved that theory wrong. Both assets got crushed by the same force, rising interest rates and inflation. The negative correlation that investors had counted on for decades simply vanished. And this wasn't an anomaly. This was a preview of the new reality. I remember the exact moment I realized how profound this shift was. It was March 2022, and I was looking at our risk models at Bridgewater. Everything was flashing red. Not just stocks, not just bonds, but entire asset classes that were supposed to be uncorrelated were moving together. The traditional diversification that had protected portfolios for generations was failing. And that's when it hit me. We're not just in a bear market. We're in a paradigm shift. The investment framework that worked from 1980 to 2020, falling interest rates, moderate inflation, globalization, and stable monetary policy, that era is over. We're entering something completely different. This has happened before. Every 40 to 50 years, the entire investment landscape gets rebuilt from the ground up. The 1930s gave us the concept of government bonds as safe investments and stocks as long-term growth vehicles. The 1970s taught us that inflation can destroy both stocks and bonds, leading to the rise of alternative investments and international diversification. Now we're in the 2020s, and everything is changing again. But most investors are still using the old playbook. They're like generals fighting the last war with outdated strategies and obsolete weapons. At Bridgewater, we've been preparing for this shift for years. We've studied every major paradigm change in financial history, and what we've learned is this. The investors who recognize these transitions early and adapt their strategies accordingly build enormous wealth. The ones who cling to the old rules get wiped out. So let me give you the 5 new rules that will define successful investing from now until 2030 and beyond. These aren't minor tweaks to traditional strategies. These are fundamental shifts in how you need to think about building and preserving wealth. Rule number 1, traditional asset allocation is dead. Replace it with barbell strategies. The 60-40 portfolio worked when we lived in a low-inflation, falling interest rate environment. But that world is gone. Today's economy is characterized by higher inflation, rising rates, supply chain disruptions, and massive government debt. In this environment, you need what I call a barbell strategy. On one end of the barbell, you need ultra-safe, inflation-protected assets. I'm talking about Treasury inflation-protected securities, short-term government bonds, commodities, and even some cash positions. These aren't exciting investments, but they preserve purchasing power when everything else is falling apart. On the other end of the barbell, you need high-growth, high-risk assets that can generate returns significantly above inflation. This includes growth stocks, private equity, venture capital, cryptocurrency, and emerging market investments. These assets are volatile, but they have the potential to create life-changing wealth. What you don't want is the mushy middle, traditional diversified portfolios that give you mediocre returns with moderate risk. In a world of extreme volatility and rapid change, mediocre strategies produce mediocre results, and mediocre results mean you're falling behind. Rule number 2, geographic diversification isn't enough. You need system diversification. For decades, investors were told to diversify globally. Own US stocks, European stocks, Japanese stocks, emerging market stocks. Spread your risk across different countries and regions. This made sense when different economies moved independently. But globalization changed everything. Now when the US sneezes, the whole world catches a cold. We saw this in 2008 in 2020, and we're seeing it again today. Geographic diversification provides much less protection than it used to. What you need now is system diversification. You need to diversify across different economic and monetary systems. This means owning assets that perform well in different scenarios: inflation versus deflation, growth versus recession, stability versus chaos. For example, Bitcoin and other cryptocurrencies aren't just speculative investments, they're hedges against monetary debasement and government overreach. Gold isn't just a traditional store of value, it's insurance against financial system breakdown. Real estate isn't just a local investment, it's a hedge against currency devaluation. You need to think like a financial survivalist. What assets would protect you if the dollar lost its status as the world's reserve currency? What investments would thrive if inflation hit 10% or 15%? What would preserve your wealth if the traditional banking system faced another crisis? Rule number 3. Passive investing is becoming a trap. Active strategy selection is the new edge. For the past 20 years, passive index investing dominated everything. Buy low-cost index funds, hold forever, ignore the noise. This strategy worked brilliantly during the Great Bull Market from 2009 to 2021. When everything goes up, you just need to own everything. But we're not in that world anymore. Market returns are going to be much more divergent. Some assets will do extremely well, others will get crushed. The rising tide lifts all boats environment is over. In this new world, passive investing means you're guaranteed to own a lot of garbage, along with the good stuff. You'll own the disrupted companies along with the disruptors. You'll own the industries being automated away along with the ones doing the automating. This doesn't mean you should start picking individual stocks or trying to time the market. What it means is that you need to be much more strategic about which markets, sectors and themes you're getting passive exposure to. For example, instead of owning a broad market index, you might own separate indices for technology, healthcare, energy and emerging markets, and actively adjust the weightings based on economic cycles and market conditions. Instead of just owning US stocks, you might allocate to India, Vietnam, Laos or Africa, markets that are earlier in their development cycle and less correlated to US monetary policy. The key is being passive within your chosen areas while being active about which areas you choose. This is what we do at Bridgewater with our all-weather strategy. We're systematic and rules-based, but we actively adjust our allocations based on changing conditions. Rule number 4, you must own alternative assets. They're not alternative anymore. Here's a secret that institutions have known for decades, but individual investors are just discovering. The biggest returns don't come from public markets. They come from private markets. University endowments like Yale and Harvard have been putting 50% or more of their portfolios in alternative investments for years. Pension funds, sovereign wealth funds, family offices, they all have massive allocations to private equity, private credit, hedge funds and real estate. These investments aren't alternative to them. They're core holdings, and there's a good reason why. Private markets offer several advantages over public markets. First, they're less efficient, which means skilled managers can generate higher returns. Second, they're less volatile because they're not marked to market every day. Third, they often have structural advantages like leverage, illiquidity premiums, and tax benefits. But until recently, these investments were only available to accredited investors with millions of dollars. Now, that's changing rapidly. We're seeing the democratization of alternative investments through interval funds, tender offer funds, and new SEC regulations. At Bridgewater, we've always believed that every portfolio should have significant exposure to alternatives. Not 5% or 10%, but 30% to 50%. This isn't speculation. This is how you generate the returns you need to maintain and grow your purchasing power over time. The specific alternatives you choose depend on your situation, but everyone should have some exposure to private real estate, private credit, and private equity. These asset classes have historically generated returns 2% to 4% higher than public markets, and that difference compounds into enormous wealth over time. Rule number 5, liquidity is a luxury you can't afford. Embrace illiquidity premiums. This might be the most counterintuitive rule, but it's crucial. Most investors are obsessed with liquidity. They want to be able to sell their investments at any time for any reason. They think liquidity equals safety. But in today's market environment, this obsession with liquidity is costing them enormous returns. The most attractive investments often require you to lock up your money for several years, and in exchange for that illiquidity, you get paid a premium. Think about it logically. If two investments offer the same expected return, but one is liquid and one is illiquid, which one do you think will be priced higher? Obviously, the liquid one, which means the illiquid one offers better value. This is called the illiquidity premium, and it's one of the few free lunches left in investing. By accepting illiquidity, by being willing to lock up some of your money for 3, 5, or 7 years, you can earn significantly higher returns. Private equity, private credit, and private real estate all offer illiquidity premiums, so do certain hedge fund strategies, structured products, and direct investments in businesses. Obviously, you can't put all your money in illiquid investments. You need some liquidity for emergencies and opportunities. But the majority of your long-term investment capital should be earning illiquidity premiums. At Bridgewater, when we manage money for pension funds and endowments, a huge portion of the portfolio is in illiquid investments. These institutions understand that they're investing for decades, not months. They can afford to lock up capital in exchange for higher returns. Individual investors need to think the same way. If you're saving for retirement and you're more than 10 years away, why do you need daily liquidity? Why not earn the illiquidity premium instead? Now, implementing these 5 rules isn't easy. It requires you to think differently about risk, return, and diversification than you've been taught. It requires access to investments that most brokers don't offer, and it requires a level of sophistication that many individual investors don't have. But here's the thing, you don't have a choice. The old rules don't work anymore. The traditional strategies that your parents and grandparents used to build wealth are not just inadequate, they're dangerous. I keep coming back to 2022 because it was such a clear demonstration of this reality. Investors who stuck with traditional 60-40 portfolios got crushed. But investors who had already adapted to the new rules, who owned inflation-protected assets, alternatives, and global diversification, they not only survived, they thrived. This is what I mean when I say we're in a paradigm shift. It's not just that some strategies work better than others, it's that the strategies that worked for the past 40 years will actively destroy wealth going forward. And this shift is accelerating. Artificial intelligence is changing how markets operate. Geopolitical tensions are reshaping global trade. Central bank policies are becoming more unpredictable. Demographic changes are altering consumer behavior. All of these forces are making traditional investment approaches obsolete. But they're also creating enormous opportunities for investors who understand the new landscape. At Bridgewater, we're seeing institutional investors completely restructure their portfolios based on these new realities. Family offices are moving billions of dollars from public markets to private markets. Sovereign wealth funds are dramatically increasing their allocations to alternatives and real assets. The smart money is already adapting. The question is, when will you? Because here's what concerns me most about this paradigm shift. It's not just creating new investment opportunities, it's creating a new class structure. There are going to be 2 types of investors going forward, those who understand and implement the new rules, and those who don't. The ones who adapt early are going to build enormous wealth over the next decade. The ones who stick with traditional approaches are going to see their purchasing power slowly erode, their retirement dreams deferred, and their financial security threatened. This isn't a prediction. This is what always happens during paradigm shifts. The early adopters get rewarded. The late adopters get left behind. And the really scary part is that most people don't even realize this shift is happening. They're still reading the same financial advice that was written 20 years ago. They're still following strategies that worked in a completely different economic environment. Their financial advisors are still recommending 60-40 portfolios. Their 401k plans are still offering the same old mutual fund options. The entire traditional financial services industry is designed around the old rules, not the new ones. So if you want to succeed in this new environment, you're going to have to educate yourself. You're going to have to seek out new sources of information and new types of investments. You're going to have to think like an institution, not like a retail investor. This is exactly what we're seeing happen in real time. The gap between institutional investment performance and individual investor performance is widening dramatically. Institutions have access to better investments, better strategies, and better information, and that gap is becoming a chasm. But it doesn't have to stay that way. The barriers that kept individual investors out of institutional quality investments are breaking down. New technologies, new regulations, and new business models are democratizing access to alternatives. Over the next 5 years, individual investors are going to have access to many of the same tools and strategies that institutions use, but only if they're prepared for it, only if they understand the new rules and are ready to implement them. That's why timing matters so much right now. We're at the very beginning of this paradigm shift. The new investment infrastructure is being built as we speak. The new products are being launched. The new opportunities are being created. But like every paradigm shift, there's a window of opportunity for early adopters, and that window is closing faster than most people realize. The institutions that dominate investing today, the BlackRocks, the Bridgewaters, the university endowments, they didn't get big by following conventional wisdom. They got big by recognizing paradigm shifts early and positioning themselves accordingly. And the individual investors who are going to build significant wealth over the next decade are the ones who do the same thing. They're the ones who stop following the old playbook and start implementing the new rules. Because in 5 years, when these strategies become mainstream, when every financial advisor is recommending alternatives and barbell strategies and system diversification, it will be too late to get the early mover advantage. The new paradigm is here. The old rules are dead. The only question is, are you going to adapt or are you going to be left behind? The choice is yours, but the clock is ticking.